Hi, and welcome to Accounting for Foreign Currency, or more specifically, how to account for changes in foreign currency rates. We're going to look at why this issue is important, as well as how to account for foreign currency transactions and foreign currency translations. I suppose the first question is to ask, so what? First of all, globalization has meant increasing global trade. According to the WTO, the dollar value of world merchandise exports was $18.3 trillion in 2012. And that's only merchandise exports. Secondly, the majority of the world's currencies are floating. The US government moved from a gold standard in 1971, and the majority of the world's currencies followed suit in 1973. What we see here is a 5-year graph of the Australian dollar, or AUD, as compared against the Great British Pound, or GBP. The weakest the Aussie was against the pound in that period was the 19th of October 2008. When one Australian dollar bought only 39.31 British pence. Not exactly a great time for an Australian to be in the UK, which was unfortunate as I was exactly there at that time for a friend's wedding. A cheap trip it wasn't. Since that time, the Aussie has increased so that one Australian dollar was buying 68.86 British pence in March this year. This equates to an increase of over 75%. These currency fluctuations mean that even though the foreign currency amount of an item remains static, for example, you may owe £100,000, but in terms of local currency, i.e. the Australian dollar, this value may change substantially. The question then is, how do we deal with this change? The way that this gets dealt with is covered in AASB 121, the effects of changes in foreign exchange rates. This is effectively equivalent to IAS 21 for anyone using international accounting standards. There are two types of situations we are going to look at. The first is foreign currency transactions, and the second is foreign currency translations. Before we get to the technical definitions, I'll provide a general overview. An example of a foreign currency transaction is when an entity in one country, say Australia, sells inventory to an entity in another country, say New Zealand, and receives payment in the currency of the foreign country, so in this case New Zealand dollars. The issue is, how do we recognise that 5 New Zealand dollars on the books of the Australian entity? An example of a foreign currency translation is when an entity in one country, again let's say Australia, has operations in multiple countries. In this instance, the Woolworths Group have companies in both Australia and New Zealand, amongst others. Woolworths present their financial statements in Australian dollars, which is fine for the Australian subsidiary, but the New Zealand subsidiary will have their financial statements in New Zealand dollars. A foreign currency translation is the process of converting the New Zealand subsidiary's books into Australian dollars. So now you have a sense of the differences, let's look at a foreign currency transaction in more detail. According to paragraph 20, a foreign currency transaction is a transaction that is denominated or requires settlement in a foreign currency. This includes transactions such as buying or selling goods or services, and borrowing or lending money. Now, before we look at the accounting requirements, it's useful to check out a few definitions, otherwise the requirements might not make sense. The first set of definitions relate to different types of currencies. These currencies are foreign. This is a currency other than the functional currency of the entity. Functional. This is a currency of the primary economic environment in which the entity operates. And lastly, presentation, which is a currency in which the financial statements are presented. For our purposes, I will assume that the functional currency and presentation currency are the same for the examples we use. So if the functional currency is the Aussie dollar, then the presentation currency is also the Aussie dollar. In reality, it's going to be pretty rare to see a reporting entity with a functional currency different to its presentation currency. To determine what the functional currency is, you need to look at what the primary economic environment is in which the company operates. This is normally the one in which it generates and expends cash. So for Woolworths in Australia, customers mainly pay in Aussie dollars, and it will pay its suppliers mainly in Aussie dollars. So it's probably a fairly safe bet to assume its functional currency is Australian dollars. But a mining company like BHP may be more difficult. It's possible most of its costs may be Aussie dollars, but it generates most of its cash in US dollars, as most commodities are US dollar based. This requires a higher degree of judgment. Paragraphs 10 to 13 provide additional detail. The second set of definitions relate to different types of rates. The first of which is the exchange rate, which is simply the ratio of exchange for two currencies. The second is the spot exchange rate, which is the exchange rate for immediate delivery. And lastly, the third is the closing rate, which is the spot exchange rate at the end of the reporting period. Okay, now we've covered the various currency and rate definitions, let's look at the initial accounting. This is pretty straightforward. Paragraph 21 requires that a foreign currency transaction shall be recorded on initial recognition in the functional currency. To do this, we need to apply the spot exchange rate between the functional currency and the foreign currency at the date of the transaction. So for example, if I was a reporting entity, which I'm obviously not, but if I was and I bought a pair of shoes today from the US, I would convert the US dollar cost of the shoes to Australian dollars by using the exchange rate today. Before we head off and look at how we account for the subsequent impacts of changes in foreign exchange rates, we need to check out one more definition, which is what a monetary item is. This is important because an item's status as a monetary or non-monetary item affects how it gets accounted subsequently. Monetary items are units of currency held and assets and liabilities to be received or paid in a fixed or determinable number of units of currency. So for example, cash, accounts payable, accounts receivable, or loans. We'll look first at the subsequent